Support and resistance is the most foundational and important concept in price change, technical analysis, and investing. These ideas have existed for thousands of years, as they date back even to bartering. Prices move because of supply and demand. When demand is greater than supply, prices rise. When supply is greater than demand, prices fall. Sometimes, prices will move sideways, as both supply and demand are in equilibrium. Support occurs when a downtrend is expected to pause due to a concentration of demand. A support area is also a demand zone. Resistance occurs when an uptrend is expected to pause temporarily due to a concentration of supply. A resistance area is also a supply zone. But why does price react to them? It's because of market psychology, which plays a major role as traders and investors remember the past and react to changing conditions to anticipate future market movements. Market psychology is largely related to human psychology. For support, the lower the prices go, the more attractive prices become to those waiting on the sidelines to buy the shares. At one point, the demand that has been slowly increasing will match the supply or become greater than the supply. As attractive prices consistently repeat, it will be clear that the price will be less likely to drop below, and everyone expects everyone to buy. The same occurs the other way for resistance and people wanting to sell. Prices move up because there's more demand than supply. As prices move higher, there will come a point when selling will overwhelm the desire to buy. Moreover, round numbers such as $50 or $100, etc. per share may be support and resistance levels, as people tend to think in terms of round numbers, and it carries on to the market psychology. Many target prices or stop orders set by either many retail investors or large investment banks are placed at round price levels rather than at prices such as 100.06. So many orders are placed at the same level. But how do you use these levels? Once an area or zone of support or resistance has been identified, which can be identified on charts using trend lines, moving averages, etc., those price levels can serve as potential entry or exit points. As price reaches a point of previous support or resistance, it will do one of two things. Bounce back away from the support or resistance level, which is generally called a bounce or a trend continuation, or violate the price level and continue in its prior direction until it's the next support or resistance level, which is generally called a breakout or a trend break. Most investors' strategy is to anticipate a bounce, say, from a support and have a buy order, and if it drops a bit below the support, they sell for a small loss only, with the chance of reaping huge gains if it goes the other way. However, because so many people do this, prices often wick out most investors, meaning price goes further than the support or resistance to trigger a stop loss or make people exit for a small loss just before actually bouncing the right way. This can also be called a false breakout. It is very important to know how to counter these. Flexibility is crucial to correctly interpreting these chart patterns. You should have a wider stop loss point to avoid wickouts and wait for confirmation for an actual breakout with a retest, or if the price stays past the level after the candlestick closes. This is why support and resistance levels are sometimes referred to as zones. Support and resistance trend lines can also be diagonal. It is best to identify trend lines between 0 and 45 degrees, as if the trend line is too steep, it is less reliable or accurate and therefore could lead to losses. A support level can also become a resistance level, and a resistance level can also become a support level. This is especially common in breakouts and retests, or when the price reaches the same level after some time. Moving averages, Fibonacci retracement levels, etc. are indicators that carry on the same aspects as basic support and resistance. Choosing to only use support and resistance levels in your trading can be a quite profitable option. But the beauty is, you can use different indicators together to incentivize you to make the best and most profitable buy and sell decisions, and ultimately be a highly successful investor. Don't forget to like and subscribe. With us, you can learn and master investing, business, and finance just by watching our videos. The opportunity is right here. Take it and you'll see your life change.